Xavier and I reconnected when I was buying laundromats in Los Angeles, and I was negotiating leases, and I was talking to anybody and everybody that could help me. And I knew he was in commercial real estate and he had a lot of focus in retail. And I had a tricky lease that I was dealing with, and I had reached out to him to reconnect and talk to him about this particular lease. And from that, we started looking at opportunities. And eventually I said, hey, you've got access to deals, tons of deals. Let's get together and provide value to investors through the network that you've developed over 25 years and put things together for people and bring people together to do some great investments. And we could bring my management experience to your network and ability to find deals and add a lot of value for investors. And that's what we did. I bought this, I went for stores that were failing, that had the infrastructure so I could buy them at below replacement cost, get in there with and negotiate good lease terms because they were failing businesses. The landlords wanted to have a stable tenant. I presented well as someone who could, one, turn it around, and two, had the means to do it, and negotiated really good lease terms. And then I'd put the capital into rebuilding the stores. I wouldn't buy the real estate. And I could generate high cash flows by finding good locations that way. If you buy the real estate, you got to have obviously more capital. So I focused my capital on the business assets, not the real estate. So I could buy more laundromats and build out the business instead of having all my capital in one location. We reconnected about 12 years ago now, and our primary thesis early on had been very opportunistic, very much like my experience in laundry was they were distressed assets with a story. And I'd put the vision together on how I could get those turned around. And so when we came together, we had a very similar philosophy, and he, with his portfolio that he'd bought over the years, had been doing the same thing. And so we've had that experience of turning around assets that were struggling, and we were very opportunistic. On this next fund, we're going core plus, value add core plus, to where there's a little bit less of a lift on the remediation aspect of it, so that we can scale our organization more and spread out the investments and provide more opportunities to investors in a diversified portfolio, instead of spending so much time on very high demanding, heavy lift opportunistic. We'll still do those, but for fund two, we're going to focus on core plus value add. When we started, the asset classes we were interested in agriculture, things that we knew. We were interested in agriculture, retail, office, and apartments. So we actually were spread across pretty large variety of assets. But the fundamental aspect of our thesis was that there was money left on the table by either undercapitalized asset, undermanaged or mismanaged asset that had a market around it that would allow for, a higher level of profits. That was fundamental. But asset classes were those four: agriculture, retail, office, and multifamily apartments. Discounted present value of future cash flow. It all comes back to that. And yes, there's specialty that's needed in each asset class. I 100% understand that and agree. And the more you do one asset class, the better you're going to be at defining value, finding opportunity, managing vendors, building the network of expertise, the people around you need to execute. The fundamentals are all the same, though. Being able to identify good vendors to support your business plan, right? Leading people, negotiating at fair prices for the purchase, ensuring that you're able to write leases, have a market, right? Going back to the fundamentals of my childhood of understanding the economics of the demographics, the GDP of the local area, what's driving economic growth. Those things all apply to each one of those businesses. Now, granted, agriculture is a much different beast because it's got international. Its product is shipped internationally, and you've got large local forces that impact that industry. But retail and apartments and office, those economics and understanding of the market are very much the same, I see. We raised about 4.5 million in equity for Fund One, which we called the Founders Fund. And we have returned, that was about 2 years ago, and we've returned probably 30% of the original investment so far. And we're, now cash flowing every quarter, paying dividends on that. So, the ultimate terminal value, we can't say until we sell, right? But, they've gotten that level of their original capital back.